Hi, Assalamualaikum. My name is NURIN Binti Muhammad HISHAMMUDDIN from MBA1194D. In this video, me and my group member will going to present about Chapter 1, Chapter 2, Chapter 4, 5, 6 and 7 of Financial Analysis subject. I will start with Chapter 1, which is Introduction to Financial Management. First of all, we should know about three main areas in finance, which consist financial market. It deals with the security market and financial institution. Secondly, investment, which focus on the decision made by both individual and institution investor. For the third main area is managerial finance, which involve decision made within the firm regarding the acquisition and the use of funds. Financial management is concerned with raising financial resources and their effective utilization toward achieving their organizational goal. Next, the goal of an organization. The goal of a firm is to maximize the shareholder wealth through maximizing the price of the firm common stock. Goals are critical to organizational effectiveness as they serve as an objective and they work to achieve it. It is important to getting and staying profitable in an organization. Next point is the reason why maximization of shareholder wealth is preferred over profit maximization as the objective of a firm is because of the time pattern of returns. The second reason is risk. The financial manager will look for the project that offer the highest return without considering the risk that is allied with the expected return. Usually, the higher the return, the higher the risk involved. Lastly, the dividend policy. If the firm aim only to maximize the profit, they will never pay the dividend. Firms sometimes experience the increasing in earning without favorable change in market stock price. Next, function of financial manager. For the first function, performing financial analysis means a financial manager must be able to transform the financial data into a form that can be used to monitor the firm financial condition. Second, financial forecasting and planning, which means a financial manager must be able to estimate the future financing that's needed to support the increase in production capacity. Third, financing decision is doing in-depth analysis of all the available financing alternatives, their costs and their long-run implication on the firm financial condition. Next is making investment decision. It is determine the amount and composition of current and fixed asset needed to be held by the firm to run its business activity. Last but not least, asset management decision means the financial manager should manage the firm asset efficiently to ensure the firm gets most benefit out of this asset. The definition of financial market. It is a marketplace in which people buy and sell financial assets such as bonds, equities and derivatives. It can be divided into two markets, which is money market and capital market. The advantage of financial institution to the financial market are it can reduce the time and cost of transferring funds, and it is also reducing the risk faced by the investor and saver. That's all from me. Thank you.
Assalamualaikum and hi, my name is Nur Qashrina Najwa Binti Fazali. In this video, I will present Chapter 2 in Financial Analysis, which is Depreciation and Taxation. Basically, a depreciation is the technique of distributing a fixed asset cost throughout its expected useful life. A non-cash expense is which the expenditure is recognized as the asset is utilized over time. It will only deal with tangible assets such as buildings, while taxation is the payment of fee based on corporate profit or asset disposal. The sale or disposition of an asset directly influences the firm's cash flows from sales since it generates tax liabilities. The first depreciation method is the straight line method, where depreciation is dispersed evenly over the asset's estimated life. Second, DDBM. The depreciation occurs early in the life of the asset and less in later years. The last is the sum of the years digit depreciation method produces additional depreciation charges throughout the life of the asset. For this video, I will only explain the sum of the year digit method and its taxation computation. From the question, the machine cost is 55,000 ringgit with a useful life of 4 years. Its salvage value is 3,000 ringgit and has an additional cost of transportation of 1,000 ringgit. The selling price after 4 years is 27,000 ringgit and the earning before tax is 50,000 ringgit and the corporate tax rate is 30%. For the first step, we must determine what kind of depreciation method this question uses. It is a sum of years digit method. Secondly, this method, we are required to calculate for its sum of digits, which is useful life times with a useful life that has been added with 1, and the answer must be divided by 2. Therefore, for these questions, 4 times with 5 divided by 2 equal to 10. This means the SOD is 10. Next, the table will be constructed. For this method, we have to use the cost that has been minus the salvage value. As we can see, the cost is 55,000 ringgit plus transportation cost of 1,000 ringgit, which equal to 56,000 ringgit. In the table, 56,000 ringgit need to be minus with the salvage value of 3,000, which equal to 53,000 ringgit. And to find each year's book value, the initial cost minus the accumulated depreciation as shown from the table. For the example, for the first year, 56,000 minus 21,200, and by that we will get the book value for the first year. Next is the taxation. First of all, the book value is the initial cost minus accumulated depreciation. From the table, we can take the book value of year 4, which is 3,000 ringgit. Second, capital gain equal to selling price minus initial cost, which is 27,000 minus with 55,000 equal to minus 28,000. This means the capital gain tax doesn't have to be calculated. Third, profit or loss. Selling price minus initial cost, 27,000 minus 3,000 equal to 24,000. Since the company doesn't suffer from loss, the tax on RAD has to be calculated. To calculate tax on the RAD, we need to choose the lower amount between profit and the accumulated depreciation. For this question, the profit is lower, therefore it needs to be times with the corporate tax rate given in the questions, which is 24,000 times with 30% equal to 7,200. Since this company got a capital loss, the tax on capital gain will equal to 0. Fifth, tax on earning before tax, EBT times corporate tax rate. From the question, the EBT is 50,000 ringgit, therefore 50,000 times with 30% equal to 15,000. Lastly, the total tax liability, we need to add all the tax, whereas 7,200 plus with 0 plus with 50,000, so the total tax liability for Deodato company is 22,000.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Qashrina Najwa and I will present about the chapter 4, which is the risk and return relationship. Generally, I will describe about the meaning of the risk and return, types of risk, and the formula to calculate risk and return. Before that, I will explain about the definition risk and return. Risk means that the potential unexpected events to occur. For example, risk in a new business are difficulty in getting a new customer and competition between sellers who sell the same goods. Return is about the reward we expect from the investment. For example, an investor invests in a new company project and they will get a return after the project is completed. Relationship between risk and return. Risk is probability of not realize the expected return when making an investment. Every investment has a potential variability in its expected returns. The bigger the chance that actual outcome may differ from an expected, the greater the risk. So risk and return trade-off state that high risk, high return. However, low risk, low return. There are two types of risk, which is called systematic risk and unsystematic risk. Systematic risk is also known as a diversified or specific risk. It's about the risk specific to a particular security and can be eliminated through diversification. It also can be considered as a controllable risk. For example, the risk of the entry of a new competitor into a market and the risk of company is forced to recall one of its products. Second risk is called unsystematic risk. It also known as a non-diversified risk or market risk. Actually affect the overall market, not just a particular stock or industry. This risk is caused by the event that affect the stock market and cannot be eliminated through the diversification. For example, include war, recession, and radical changes in monetary policy. Generally, systematic risk cannot be controlled, minimized, or eliminated by the organization or industry as a whole. On the other hand, unsystematic risk can be easily controlled, minimized, regulated, or avoided by the organization. Thus, systematic risks are a result of external factors. Risk and uncertainty is two different terms that are involved in the risk and return relationship. Firstly, risk is about the probability of outcome that we can know, we can estimate the risk. But uncertainty is about the probability of outcome that we cannot estimate in the future. The formula to calculate risk and return. Actually, the statistical indicators used to measure risk are by calculating the standard deviation and coefficient of variation. Thus, a high or low standard deviation or the coefficient of variation is associated with the high or low risk. So, this is the formula to calculate risk and return. So, that's all from me. Thank you.
Hi, Assalamualaikum. My name is Binti and SABRY from MBA1194D. I will explain Chapter 5, Cost of Capital. There are three sources of long-term financing. The first one is bond or debt. It is a long-term promissory notes issued by firms. The interest amount is fixed and it is a liability. Second, preferred stock is hybrid security with fixed dividend without maturity period. Preferred stock is an equity and the dividend amount is based on the contract. Third, common stock is represent ownership position in the firms. The dividend amount is fixed and it is an equity. Which average cost of capital WACC is method used to find the overall cost of financing through the combination of at least two sources of financing and proportional weight is assigned to each sources of financing. Weight margin cost of capital WMCC is method used to find the cost of capital when addition amount of capital is raised. Each sources financing has their own advantage and disadvantage. Debt financing is cheaper than equity financing because it is a tax deductible. Equity financing is less risky compared to debt financing. Both sources of financing reduce its financial risk. As you can see on the slide, this is the formula for calculation of cost for each sources. And please refer to the note to understand all the short form in the formula. This is example question to calculate cost of each sources. So, Kalisa Berhad needs RM 100 million for its latest long-term project. So, in the question has given the balance sheet at 31 December. Sources of long-term finance. A. Bond, 20 years bond having 12% coupon rate and issued at 5% and flotation cost is 1 of per. Corporate tax is 30%. B. Preferred stock. Dividend is 8%. Price is 2% premium and flotation cost is 5%. C. Common stock. Price of common stock is RM50. Expected dividend is RM5 per share. Growth is 7% and flotation cost is RM8. Personal tax is 20%. Brokerage fee is 1.5%.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Qashrina Najwa Binti Muhammad ASRI. I will be presenting about Chapter 6, Operating Leverage and Break-Even Analysis. Three main points in operating leverage are fixed operating costs, variable operating costs, and operating leverage. Fixed operating cost is the cost that is associated with operating a property that doesn't vary in the short term. These costs don't change with property occupancy rates. For example, rent, insurance premium, and property taxes. These costs will not change even the amount of sales is increasing. Next, variable costs, like the name implies, are comprised of costs that vary with production. Unlike fixed costs, variable costs increase as production increases and decrease as production decreases. Examples of variable costs include raw material costs, the cost of electricity, labor costs, selling commission, and etc. Operating leverage showing the responsive of earning before interest and taxes to the changes of sales volume due to the use of fixed costs used by the firm. As you can see from the slide, these are three ways to calculate degree of leverage. Degree of leverage is the percentage changes in EBIT resulting from the percentage changes in sales. This is how you can interpret degree of operating leverage. If sales increase by 1%, EBIT will increase by the positive of degree of operating leverage number. If sales decrease by 1%, EBIT will decrease by the negative number of degree of operating leverage. Break-even analysis is method used to determine the level of sales that a firm must reach to cover its operating costs. Break-even happens when operating income equal to 0 and implies sales revenue equal to cost. This is the example for calculation of break-even. YAN Enterprises is a producer of microprocessor. The selling price of each microprocessor is 50 ringgit. The variable cost per unit is 35 ringgit. The company has a fixed cost of 250,000 ringgit. Calculate the following. The question asks us to find break-even point in unit and sales. The formula to find the break-even point is fixed cost divided with selling price per unit minus with variable cost per unit. To answer these questions, 250,000 ringgit divided with 50 ringgit minus with 35 ringgit, and you're gonna get 16,667 units. To find break-even point in sales, break-even units, which is 16,667, multiplied by selling price per unit, which is 50 ringgit, and you're gonna get 833,350 ringgit. The next question is to find EBIT for 5,000 units. To find EBIT, total sales need to be minus with total cost. From the question, 5,000 units multiplied by 50 ringgit and minus with bracket 250,000 plus with 5,000 units multiplied by 35 ringgit. And the answer is loss of 175,000 ringgit.
Hi and Assalamualaikum. My name is NABILAH Binti Abu Kasim. In this video, I will explain about Chapter 7, which are financial leverage and capital structure. Leverage is the magnifying effect of using fixed costs on the returns to the shareholders. The use of debt borrowed cash to boost the profits on an investment or project is known as leverage. Leverage allows investors to increase their purchasing power in the market. Instead of issuing shares to obtain cash, firms might utilize debt to invest in business operation in an attempt to improve shareholder value. There are three types of leverage, which are operating leverage, financial leverage, and total leverage. Operating leverage is the relationship between sales and earnings before interest and tax, EBIT. Fixed costs have to be paid regardless of the level of the firm's sales. EBIT will increase or decrease at higher percentage than the increase or decrease in sales. Operating leverage also can be measured by the degree of operating leverage. Next is financial leverage. Financial leverage is the relationship between EBIT and earning per share EPS. The percent of fixed cost funds will result in greater percent of change in earnings per share than in EBIT. For the total leverage, it is the combined effect of operating and financial leverage. It also measured by the degree of total leverage or degree of combined leverage, DTL or DCL. So let's move to the calculation. This is the formula and the equation for point of indifference. Point of indifference is the level EBIT that generates the same EPS for combination of two or more methods of financing. Regarding this question, the step we have to do is, step first, existing structure, which are interest on bond, preferred stock, and number of common share. The formula is value of common share divided price minus flotation cost. Based on the question, the result must be 3.3 million divided 30 equal to 110,000 shares. Step 2, to raise 2 million, it must have a plan. In step 3, plan 1 such on the diagram. Total order cost of every structure based on the question, and for plan 2, the step is also same like plan 1. For the step 4, calculate the EPS for each plan. For EPS 1, the formula is EBIT minus interest and 1 minus tax rate and minus preferred stock dividend divided to number of common share outstanding. Based on the question, 1.5 million minus 164,000 and 1 minus 40% and minus 19,000 divided to 135,000. And the answer would be 5 ringgit and 27 cents. For EPS, the formula is same like EPS 1. Step 5, sketch on the diagram. Calculate the point of indifferent EBIT based on the answer EPS 1 and EPS 2. Step 6 is calculate the point of indifferent for EPS 1 and EPS 2. And lastly, for the step 7, draw chart based on EBIT versus EPS such on the diagram and choose which one are the better plan.